What are we looking at this year?
Well, you know, my forecasting abilities are usually imperfect,
yes.
But luckily I was able to stop by the Port Authority bus terminal and get a pair of glasses that allow me to see.
I love them. Put them on.
Put them on.
And I can see.
So you are now obligated to keep those on.
You got to wear those for the
Oh,
segment.
no.
That's how this works.
Yes.
That's how this works.
Oh, Brendan will do it.
That's
I know
my
Brendan
job
will do
in this
it.
studio. I'm a monkey. I bang my cymbals for the people.
Okay, so your first number, Peter.
Yes.
Okay, let's do $53,380. Is the median income? Or
That's the
typical American
median
family?
household income in the United States as calculated by Sentia Research, which provides more updated numbers than you're able to get from the Census Bureau. And that is up from 2011, which was the low point, but still down from not only the beginning of the recession in December 2007, but it's down like about 6% from the year 2000. So we feel like we've come up from the trough, and we have, but we still have a long ways to go to get back to prosperity in this country.
And this is the economic indicator that matters. We talk about all sorts of things. We talk about the unemployment numbers. We talk about, this is ridiculous. But when it comes down to it, what people really worry about, all these people who are being, whose behavior is assumed in economic models, they're worried, how much did I bring in this year?
That's right. So the reason to expect good news in 2015 on the median household income number is, of course, that jobs are coming back, right? And we're starting to see some pay increases as well, which you would expect as the labor market tightens up. Employers have to offer more to get the employment, to get the people they need.
And William Cohen, what is this distracting? Is this distracting? Are you going to wear them now?
I'm going to take Brendan off. I'm going to end your torture.
Why would you call that torture? But this is, we're looking at wage increases. Next year, once we're starting to see just a hint of wage increases, Bill Cohen, you're already seeing Fed watchers say, well, we can't have that. We've got to raise the rates again.
Well, look, there's no question that we are still, a lot of people are feeling very good at the end of this year about how much money they've made, and a lot of people are not feeling so good, and I think Peter's numbers point this out, and that is the big challenge. We talk about, what Obama can do in the next 2 years to Obama can be Obama finally. Fixing that problem is a big concern, and he's got to focus on it.
So I want to get to the other numbers that Peter wants to. Okay, 387.2 million. Barrels of oil.
Right. Barrels of oil, that is the amount in the most recent measure of the U.S. government for how much is in stock in the United States, not including the Strategic Petroleum Reserve. That number is the highest for this time of year since the EIA began tracking in 1982. What that tells you is that supply continues to exceed demand, which is a reason why we just had a big drop in oil prices just yesterday. There's downward pressure on oil, and so people focus on the market price, but if you want to look at where the market price is going, take a look at stocks. That's a good indicator.
Okay, and 5.8%, the unemployment rate in November, but that's only 1 month. So what is really the key jobless rate to look for in 2015?
So if you look at what the Federal Reserve does every quarter, they update the summary of economic projections, and one of the things in there is their long-term outlook for the unemployment rate. And when they say long-term, what they really mean is sort of the stable rate, the lowest unemployment rate can get before you start getting inflation kicking in. And the range of the members of the Federal Open Market Committee, both voters and non-voters, is 5 to 5.8%. So that means 5.8 is already at the level where some people think can't really get much lower without starting to worry about inflation.
Okay.
As we move down into the mid-range of that 5 to 5.8, more and more of the Fed voters are going to say, okay, we finally hit the threshold, it's time to start cranking up the federal funds rate.
All right.
Well, Peter, but that 5.8%, how do we factor in the people who've just given up looking for work? It seems to me there are a lot of those people, and that's not being accounted for.
And that's a huge debate. There are some who say those people are going to come back in because of the attraction of higher wages, and others say, well, no, people going off on disability, for example, might never come back. That's the hysteresis argument, that once unemployment gets high and people are pushed out, that's a permanent condition. And that's a huge debate. In every Fed meeting, they discuss exactly the question you're asking, so we don't know yet.